Today we're going to talk about in-kind donations. Any individual can make a donation to the charity of their choice and in return receive a tax receipt equal to the fair market value of their gift to that charity. That individual then includes that tax receipt on their tax return in the year of question as a non-refundable tax credit. The non-refundable nature of this deduction is simply that it is the same value regardless of your tax bracket. Now, simply put, if you make less than $200 worth of donations in any given year, you will receive a 20% reduction on your tax bill of that total donation. If your donation totals greater than $200 and only on the excess portion, this reduction is increased to 40%. So therefore, it is irrelevant as to what your tax bracket is, you get the same result. Now, any individual is eligible to make a donation of a real tangible property, which is termed in kind, an example of which would be a security. The charity receives the security and gives the individual a receipt for the fair market value of that security. Any unrealized gains or losses on that security are in fact ignored in the year of donation, giving the charity the fair market value and the individual the receipt for the entire amount. So let's look at three alternatives to make a donation to our favorite charity. If we were to donate cash, we will have no personal liability, but we will have a higher personal cost of making the donation, but a high amount left in the hands of our charity. Alternatively, if we were to liquidate a security position and then donate the after-tax cash to that charity, we'll have a personal tax bill, therefore a lower personal reduction on our tax return, and a lower amount in the hands of our charity. Finally, if we look at an in-kind donation, we will eliminate the personal tax on the donation, maximize our tax reduction, and maximize the amount in the hands of our charity after making the donation. So here are a couple of strategies to remember when you're using in-kind donations. Never donate a security that is in a loss position. You're better off in that time to sell the security, capture the capital loss, and donate the remaining cash to the charity. The charity is exactly the same off, except now you get the advantage of having that tax capital loss in your own tax return. Another example of how you can enhance this strategy is consider using return of capital products, which allow you to recover and spend some of your capital and then eventually donate the remaining amount that has deferred the growth, which has now become an unrealized capital gain, get a tax receipt for the fair market value remaining, and now basically be able to get some of your capital back, give your charity the donation, and allow yourself to get the maximum donation available. Another strategy you may want to consider is any unused or unnecessary life insurance policies. You could donate to the charity of your choice, simply naming that charity as a beneficiary. Any underlying value or any premiums paid in the future on that life insurance policy will become a charitable donation to you. So how can NexGen help? Well, we will allow you to defer growth on your securities in our structure by using our compound growth class. This creates unrealized capital gains, which now enhances the strategy of an in-kind donation. We will also allow you to use a return of capital class, which will give you a monthly cash flow of your own capital, hopefully deferring 100% of the growth, which will now increase the unrealized capital gain to again enhance your in-kind donation strategy. Hopefully that will help you understand the in-kind donation strategy, and please check our website for further information of this nature.